I mean,
Oh,
just how,
absolutely. Absolutely.
where did that one come from? And so,
Have you tried grilling them, Brent?
no, but she does bake them.
Yeah, yeah. I love them, love it fried, but I don't like the mess. So I'll toss them in a little bit of EVOO and salt and pepper, and then put them on the grill for a few minutes until they've got some good grill marks in them with no mess. And then I'll eat on 3 dozen or so as a side for a week thereafter. They're great leftovers.
I'm going to try that.
You ought to, but they need to be small, obviously.
Right.
Brent, do you have the chairman's script to read?
Yes, ma'am. I've got it right here.
Okay, just checking.
We
We have 2 minutes till 10 o'clock. But once again, I just wanted to remind everybody, when the meeting starts, your screen's going to change. And when it's time to make a motion and second a motion, you will do that electronically. And then your voting screen will pop up. And if it doesn't show, either press escape or move your arrow over to your Chrome page so you can see the voting. Neil will be voting by voice today, though.
Okay.
And I have 1 minute. And Brent, Doug is online, Doug Anderson, and he does have a presentation. He's going to share his screen.
Yes.
Good morning,
There he is.
everyone.
Morning, Doug. Is Amy not with us today?
No, she had an emergency come up this morning, and
Okay.
she won't be here.
Okay.
I'm going to go back on mute. It appears that my next door neighbor is using his leaf blower right now.
Okay, Brent, it is now 10 o'clock whenever you're ready to start.
All right. Good morning. Before we get started, I have a script I need to read to everybody here as it relates to this meeting. This meeting is taking place over video conference. If the video conference is disconnected any time during the meeting shall be stopped and reconvened once the video connection is restored. If communication is unable to be restored within 15 minutes, items remaining for consideration will be continued to August 10th, 2020 at 1 p.m. via video conferencing. And with that, I would like to call the meeting to order. And item number 2 is to approve the minutes of the May 11th, 2020 meeting.
Move it.
Second.
Got no discussion, all in favor, please cast your vote.
Aye.
Passes 4-0. Thank you. Item 3 is receive the monthly investment flash report as of May 31st, 2020, June 30, 2020, and July 31st, 2020. Got to move.
Good morning, everyone.
I'll second.
So I am going to now share the board packets and go straight to the report there. Are we, is this on track? Is this,
Yes.
okay.
Yeah, Doug, we see the cover of the meeting agenda.
Okay, there we are. I'm just going to page through this if I could. If everyone can hear me okay, just a thumbs up.
Yes.
Yep.
We're good.
Very well. Okay, so we have a lot of reports to review here. I'm not going to spend a lot of time on the May 31st, given that it is rather dated. But you can see here the market value as of May 31 was $66,300,000. So it's a nice gain over the period. And I do want to remind everyone of when we started in 2009, we had $6 million. So a great deal of contributions, but also a great deal of withdrawals over that time. $21 million in gains over that period, and then income of 6.8. And that's as of May 31. So performance for May was strong and across the board. And as you will see, and I think as we all can acknowledge right now, markets and economy are not the same thing. The economy is slow right now. Obviously, we've been put into a recession to fight the pandemic, but the markets are being supported in a way we've never seen before by the Federal Reserve, the Treasury, et cetera. The United States is leading the way when it comes to this form of support of the markets, but it appears that the EU might be following us once they arrange their votes and can come to a consensus there. It's a little harder to make programs like that happen overseas. And I will say that the US government acted much faster than we've ever seen a response to a market crisis like this, or actually, I'm sorry, it's a health crisis. So going into the June 30, this is the shorter version of the report. You can see that for the month, the total fund was up 2%, a little bit more than 2. And for the quarter, it was up almost 17%. And these are net of fees. So these are fantastic rates of return. You can see the recovery was very, very fast. And remember that our allocation is heavy for equity. We have more equity than most folks do, and those were the assets that really performed well. But on a relative basis, our bonds and our domestic equity both outperformed by a pretty large margin there. Now, this is the longer report. I don't want to spend a ton of time on this. I want to save some time for questions. But just pointing out on the market environment here, this is for the quarter. This is from April 1 to June 30. And if we can all remember back, the bear market or the crash, if you would say, the COVID crash started in the mid to late February. I'll say February 18th. The market went down a quick 35%. And then on March, I believe it was March 23rd, these numbers do these dates run together for me sometimes. March 23rd, the market bottomed. And since that time, you can see how strong the returns have been. And what these figures do not show is those last few days of March where we saw markets going up, some cases almost double digits percentage-wise in a day. So the return off the bottom was very strong. It is an unusual time. It's not something we've ever faced before. We've never seen the economy pushed into a recession by a pandemic, but we've also never seen the amount of stimulus and stabilizing actions that have been put forth by the government. What we've done in the course of, 6 weeks at the very early stages of this was put out when I say we, I mean the federal government of the United States, put out more support in those days than they did for the entire Marshall Plan to rebuild Europe and mostly Japan after World War II. And those were actually, economies were actually having to be physically rebuilt, whereas what we have today is different than that. And just going back to put another point on this, if you've been watching the news, you've heard a lot about the $600 assistance payments for workers who are put out of work. In the great financial crisis, we weren't spending $600 per person per week. It was $25. So you get an idea that the magnitude of everything being done is much, much larger this time. Looking at markets here, you can see that the core markets are in the gray column here in the midst of all these. This is the quarterly performance. So, almost 20% or better than 20% returns across the board for large cap, mega cap, mid caps, and small caps. And you'll also notice here that the blue is the value side of the market and the maroon is the growth side of the market. And this is a repetition of things that we've been seeing since 2016. 2016 was the last time we saw value outperform. And in a late stage bull market, that's not a unusual thing to see. But the late stage of this bull market lasted from 2017 until the first quarter of this year. That's an extraordinarily long period of time. And what you have seen is you've seen some resurgence in value since the bottom of the market, but it just doesn't appear here. And the main reason it doesn't show here is these names right here. The market is being led by these 6 lines right here. Microsoft, Apple, Amazon, Alphabet, which is Google, and Facebook. And you see how large Microsoft is, and you see how large Apple is compared to everything else, and you see what their returns are. So information technology, consumer discretionary, which is Amazon, all of these are doing much, much better. They are benefiting from the pandemic. Microsoft owns Teams. They just took over the business that Slack was in. And you'll see that, Apple Computer, very, very successful right now. Amazon delivering to a lot of homes almost every day, advertising through Facebook, and Google also advertising. So these are the companies that are driving the price in the market right now. And if you go a little bit deeper than that, you can see other names. You've got some energy names that started to do well during the quarter. That was because they did not go bankrupt when folks thought they would. You've got Wayfair, which is home delivery of furniture. And I think they set a record during the second quarter of this year, delivering desks for people who are having to work at home. So through a variety of industries here are benefiting from this, and it's not just healthcare like you might expect. So big news to be watching for soon is there is a company that may be appearing in the S&P 500 that is not a member right now, and it's called Tesla. So to be included in the S&P 500, you have to be profitable 4 quarters in a row. Tesla has not been profitable 4 quarters in a row over their history, but they will be joining. If they are inducted into the S&P 500, they will be inducted to, and I haven't checked the share price in a week or so, but they'll be inducted as the next largest company behind Walmart. It is a $300 billion company that's not in the index. And there are some questions about how they run their business and whether whether the S&P committee will allow them in, but that's just how large that company has become very, very quickly. Looking on the next page here, you can see international. We do have international investments here, and international did keep up on the equity side very, very nicely. Over the trailing year, you can see that its performance is very wide dispersion. This EM, emerging markets, is you're seeing Brazil. Brazil being hurt very badly by the pandemic during the quarter. And also last year, you saw some other countries in Latin America hurt badly. Oddly enough, China is moving forward. They have emerged from the worst stage of the pandemic faster than we are, and that is helping performance. So going into the bond market world here, and this is important because this is sort of how we stabilize the portfolio from equity market volatility. During the quarter, returns were good. Some of it was a return to risk, where you saw high yield bonds, 10.2% for the quarter. We have some of those, but those sold off pretty dramatically during the first quarter. Trailing 1-year returns for bonds are very, very strong. And you will see that 8.5% for AAA bonds. You'll see Treasury bonds were up 10.4%. And with something I'm going to show you in a moment, we do not expect this to happen going forward unless the equity market completely falls apart. So remember, bond returns are not going to be big, but they will stabilize the portfolio if equities do sell off. Now, looking on this page, during the quarter, a number of charts were, I'll say, broken. This is one of them. This is interest rates, market interest rates in the United States. And you can see where they are. The green boxes here, it's a box because the range is 0 to 25% or 25 basis points right now. That's 0.25% is the Fed funds rate. This is how this is what banks charge each other for overnight lending. But this BAA-OAS, I know it's an alphabet soup here, but BAA is a BAA rated bond. OAS is what's called an option adjusted spread. And the really important word here is spread. So how much more do you earn owning a bond rated BAA versus a treasury. And you'll see that through, over the last year, it's been about 1.5% per year you've earned in interest about for taking the additional risk of owning that BAA rated bond. However, once we get to February, you see this spread explode because people were selling these and they were buying treasuries. So you have a spread here that goes up to 4.5%, almost 5%. It triples during the quarter, but then it goes back in very, very quickly as the Federal Reserve announces that they're supporting the bond markets. And then down here is an important slide, important chart. This is the Treasury yield curve. So this is a 1-month Treasury, and you can see it's paying 0 to 25 basis points. You have to go out to the 7-year bond before you get 0.5% per year. You have to go out to 20 years before you get more than 1% per year. And going out to the longest duration or longest maturity Treasury bond, the 30-year bond, you're getting at the end of the quarter under 1.5%, but that's gone back down to about 1.2%. So what that tells you is that looking forward, by owning a Treasury bond, if you hold it to maturity from 30 years from now, you're going to be paid 1.5 or 1.2% interest per year. And that is what your expected return should be. So we are thinking forward here. The equities have come up nicely, but if we are trying to hit an actuarial rate of return assumption of above 7%, owning bonds makes that very difficult. I'm not saying that we need to completely exit the bond market, but we are paying for the stabilization of the bonds in the portfolio. And this fits very nicely with our long-term thesis that equities provide the return that we need to produce with this pool of assets. This is as of June 30. This is the total fund trailing 1-year rate of return, 2.9%. So it was positive for the year after the rally that we had during the second quarter of this year. I'm not going to talk tons about this, but here we see the market value at $67.7 million. We're almost back up to the peak that we saw at the end of last year. So again, remember this 08-09 period, it took a long time to get back from there. This 2019 or this 2020 COVID-19 crash in the market has come back very, very quickly. Now the asset allocation, you can see again, this bump here where domestic fixed income increased, no effort on our part whatsoever, just because the equity market decreased at that time. And now here's our allocation. In big picture, we have about 70% equities and the rest in fixed income. That 70% I get there, 59% domestic versus 8.7% international. And those are long-term targets. This is where we should be. Now, our fixed income does a lot of work here. We've got the way that we allocate that is core fixed income. That's lower risk, diversified portfolio. We have the active duration, which is 100% treasuries. So there's no credit risk whatsoever. But this manager does do some interesting things to guard the portfolio from equity market volatility. You can see our international equity right here, relatively small. And then our high yield fixed income, which is a equity bond hybrid asset category. These are lower rated bonds that pay more yield than the core portfolio. So here are the list of managers that we have here. No changes to this lineup over recent periods of time, although our patience has been tested, as it is almost always tested with one or two of these managers, just given the nature of how markets and portfolios work. You can see for the quarter, started out as of April 1 with $57,934,000. And you can see we ended at 67.7. I quoted that number a minute ago. Income during the quarter was $275,000. Appreciation was a little bit more than $9.5 million. This is why we stay fully invested. I know it was extraordinarily difficult during March, during February, to say, shouldn't we be doing something? And I did not predict any of this happening as it is. But our long-term target allocation views the world in very long-term, in a perspective that is very long-term, that says equities outperform bonds. And what that allows us to do is we don't have to react. We don't have to forecast when markets don't go the way we expect to over the short run. But we are able to maintain our portfolio and take gains where we need to and allocate to underappreciated assets. So one thing on this slide to point out, equities up very, very strong, right? Our S&P 500 index was up $4 million during the quarter, right? That's most of the gain that we see here. Our fixed income, even those assets were positive, except for the Hoisington portfolio, and that's the active duration, which sort of counterbalances everything else we do. Looking here, you can see this is the total fund net of fees allocation. So versus the benchmark, we outperformed during the quarter, 4th percentile rank. For the year-to-date period, this calendar year-to-date, down 3%. We take more equity risk than our benchmark, and that's understandable. Over the last 1 year, 2.91%. We did underperform, and most of that's from the equity portfolios, but we have a big slug of it came here from Loomis sales. So going down for the quarter, our fixed income assets were up 3.75. Our domestic equity was up more than 25% during the quarter. You can see our returns here again. Loomis sales, the most aggressive, up almost 6.8%. Double line at 5.5%. Lord Abbett, high yield. So this is the below investment grade bonds at 10.9%, and Hoisington actually down on the quarter. You can see our domestic equity portfolio, the index tracked perfectly. In fact, if you look across the board, doing very, very well. Our mid-cap index portfolio up 24.96%, and again, tracking the benchmark across the board. Hotchkiss and Wiley, mid-cap value. Value's been tough. Hotchkiss is a deep value manager, so it's been even tougher for them. But coming out of a recession, their portfolio usually does very, very well, and you can see it happened during this quarter. Again, not real pleased with these longer-term results, but we endure these so we can enjoy these right here. And this portfolio is offset with our next manager here, which is Stevens Small Cap, which even had a better return during the quarter. This is small cap growth, and their returns have definitely come around nicely. And then we have our Causeway International Value up 20% during the quarter. So in big picture, equities did better. Value did pretty well during the quarter. We have exposure to those largest names that are driving the market through the index fund. And I think that's exactly the way we want exposure there because it's very cheap. And it is cap weighted. So it course corrects over time. If those 5 become not the largest 5, their replacements will take their place and we don't have to do anything. So indexing is good for the large cap part of the market. And I'd argue it's done very well in the mid cap part of the market also. One thing to point out on the 1-year rate of return here, just to point this out, so 2.91%, you'll notice some negative returns, which we would expect here. Even the bond portfolio shows some negative returns, and Loomis Sales, an aggressive bond manager. So they were down 2.76. They had some equities. They had some non-US bonds here. Thankfully, Double Line was positive. Lord Abbett, negative with the high yield portfolio. But then you can see this is sort of the rescue. This is the most valuable player over the last year, definitely. Hoisington up 29.7%. And even though these did underperform their benchmark, these 3, the return here allowed our total fixed income allocation to outperform its benchmark. Not only that, but it ranked in the 1st percentile of that, the global fixed income manager. And by global, that means worldwide fixed income universe. So MVP over the last year was Hoisington. You look at the returns here, again, some pretty amazing returns here. The volatility was very strong. And again, growth managers outperforming, value managers underperforming. And it's not just this portfolio, it's everywhere right now. So I don't want to take too much more of your time here. I want to go to a couple of pages here at the end. You can see the investment growth over the last 5 years. This is the bond managers, and one manager just took off, and that is the U.S. Treasury active duration portfolio. You'll see here that over the last 10 years, and we have 10 years of history here, that yes, the index fund is the best performer. And again, something that we see most places right now is that the large cap passive portfolios are the ones that are performing best. Past is prologue, but again, this 10-year period of time was one that featured no recession, no bear market, and extraordinarily low interest rates. And I think that's, in my mind, what causes the index fund to outperform. If you have any kind of market cycle, if you have a recession anywhere in this, then you have a period of time where smaller companies, where cyclicals do outperform, but this just hasn't been the case over the last 10 years. This is our 5-year correlation matrix. You can see some negative correlations here. That's the diversifying portfolio, which we have in place. And you'll see here that we have 2 managers that are on alert. I don't think that we want to make any changes. Again, we've been with Hotchkiss for a long time. They're part of an overall portfolio structure. They offset nicely with this Stephens small cap. Yes, Hotchkiss's returns have been very difficult, but recent periods they've done well, and they do very well coming out of recessionary environments. The portfolio is thoroughly researched, very underpriced, and actually is unappreciated by the rest of the marketplace. And then the same with Causeway, although their performance has not been as problematic as Hotchkiss's, but still think that they're a good manager going forward. And then fees, we always want to take a very close look at this to make sure that we are at very low fees. Our biggest portfolio is a Vanguard 500 index, and it's 4 basis points. The category average is 88. So we're saving a lot of money here. When we do a weighted average across the board, our expense ratio, helped by the index funds, there's no doubt about that, it's 48 basis points. Do the same weighted average calculation for the category average, and we have 1.18. So we're 70 basis points cheaper than the median of the funds available to us, and that saves almost $250,000 per year. So with that, I will pause for questions.
Does anybody have any questions for Doug?
Very well. I did not see that the 731 report was actually in, the monthly report was in the packet, but I will say that the market value was up to $70.7 million as of the end of July. So we actually did have an increase from the 67.7. So we were up almost $3 million during July also. So continued progress. Let's be patient. We've got some volatility ahead of us, but we do have a diversified portfolio. Like I said, we've got fixed income we hold to stabilize during difficult periods.
All right. Go ahead.
No, that concludes. That's everything that I had planned on saying.
All right. Does anybody have any questions?
Brent, I don't have a question, but I do think that I'd like to amend my motion to receive the monthly investment flash report for May 31st and June 30th, and ask the staff to bring back the July 31st report at our next meeting, since it's not in our packet.
Okay. All right. So we have a motion and a
Yes.
second.
The
Laura?
motion includes her amendment.
Yes. All right. We have a motion and a second. Record your votes.
I vote yes.
Neil votes yes. Motion passes 4-0. All right. Next item, we received the presentation discussion. Item 5, discussion and consider approval of additional asset allocation or changes to portfolio managers as recommended by the board investment consultant. Per my discussions with Doug and our staff, we do not have any intended changes at this time. So we'll go to item 6, and is a request to approve a request for proposal for custody services. And I believe Matt Boggs may have a few comments on this.
Yes, good morning. What you have before you today is the custody services RFP. What this would be is a request, just an authorization to go out for RFP. The last time that the trust did this was 2015. The winning proposal was Bank of Oklahoma, and we are in the last year of our 5-year agreement with Bank of Oklahoma for custody services. And so essentially what this would do is just authorize us to go out for RFP once again. And to give you an idea of what the process would look like from here, if this gets approved this morning, we would go out for advertisement for this RFP, and a RFP selection committee would be formed. The RFP would be open for about a month. At that point, the selection committee would look over the proposals, and our anticipation would be to come before you in the November meeting with a request to negotiate a contract for the custody services. And so that's what you have before you this morning, and I'd be happy to answer any questions you might have.
All right, do we have any questions? If not, if I could get somebody to entertain a motion.
So move.
We got a motion and a second. Please cast your votes.
I vote yes.
Motion passes 4-0. Thank you. Item 7 is to ratify the claims listing. I'd entertain a motion on that. Here we go. It's been moved.
I second.
Neil seconds it. Please cast your vote.
I vote yes.
Thank you, Neil. Motion passes 4-0. All right, item number 8, reports, comments from trustees, staff, and interested parties. Do any of our trustees have any comments? Seeing none. Staff, do you have any comments that you'd like to provide us?
Not this time.
Seeing none. And are there any interested parties? Francis, do we have anybody else on this meeting?
Not that I'm aware of. Mitchell, did anyone sign up to speak?
Mitchell with us still?
I guess not.
Guess not. All right. Well, seeing none, thank you all for today, and we are adjourned. Thank you.
Thank you.
Yeah.